Good morning, Becky. Yeah, I'm here at Amelia Island at the Atlanta Fed's 29th annual, is that right?
That's it.
Financial Markets Conference with Atlanta Fed President Raphael Bostic. Thanks for joining us, Raphael.
It's good to see you, Steve. Good to have you here.
I have to start with the news over the weekend, or Friday, which came out, the downgrade by Moody's of the U.S. debt. Is that an economic issue? Is it a policy issue? Is it a financial markets issue? How do you think about an event like that?
Well, first of all, it's really good to have you here,
Thanks.
and I'm always happy to be on the show. What I would say is it will cut across all of those things, and we'll just have to see how it plays out. You know, there's a lot of negotiation that's happening in Washington right now around the budget, around tariffs and the like, and I think we'll just have to see what happens. But with that downgrade, it will have implications for the cost of capital and a bunch of other things, and so it could have a ripple through the economy.
What about the impact on the desire, for example, of banks and foreign institutions to hold U.S. debt?
Well, there have been a lot of discussions about this. I know folks on this show have been talking about that as well. I think we have to really wait and see. Look, there's a lot of turbulence that's happening right now. The economy is in a lot of flux, policies in flux. There's a lot of uncertainty. I think we'll have to wait 3 to 6 months to start to see where this settles out, and I think that'll be an important determinant about people's willingness and appetite for investing in the U.S.
How does something like this get to the Fed's door? You don't deal with the spending or the revenue, but you have to deal with the outflow or outcome of it.
Yeah, so for us, I think the most significant way this plays out is really by us having to get an understanding about what businesses are going to do in this new environment, how households are going to respond, what our consumers going to take on higher price if that's in fact what happens,
right,
and then roll that up into an outlook for the future. What I will say is today, things are very much in flux. There's a lot of uncertainty. And what it means for me is, before I want our policy to move in any dramatic direction, we've got to let things sort out a bit. So that's kind of where I am right now.
Talk me through how you think about tariffs and the economic effects of them. There's a consumer angle to it, there's a business angle to it, and a financial markets angle to it, which a lot of people are talking about here. I don't want to know what data you're looking at, but what processes are you trying to figure out?
I think for me today, there are really like 3 things I'm trying to understand. The first is, once we see what the final regime is in terms of tariffs across the globe, how do businesses respond to that? Do they pass through all of it? Do they try to pass through some of it, or do they take that in margin? The second is really, how do consumers respond to whatever their business response is? So in the last episode, consumers basically took on the price and they paid it. It is unclear whether they will be able to do that today because their balance sheets are weaker than they were in the past. We don't have the same level of support. People have just lived through a high level of inflation, and so there may be greater sensitivity, which could slow down things and cause them to be much more responsive. And then the third is really, what does this mean for inflation dynamics? Are we seeing, the basic theory is tariffs are just a one-time bump and then you go back. Is that how this is going to play out? You know, to the extent that this tariff transition happens over a longer period of time, it could induce businesses and families to change their strategies in ways that wind up being structural. If that happens, then we will have to take that on board from a policy perspective.
Is there a difference in the sequence of when any of this shows up in the economic data, in the sense that you could imagine that payrolls could react immediately, but inflation takes time to figure out? So you could, in the words of Jason Furman, he said, the Fed is right to be waiting behind the curve because the danger is that it ends up being ahead of the wrong curve. So tell me about how you think about those two things.
Yeah, so we worry about this a lot in Atlanta. You know, we do a bunch of surveys where we ask CFOs, we ask businesses moving, like, what are you going to expect to do for the next 12 months? And we get that on an ongoing basis. That gives us a look-ahead peek, so that the difference in time periods and adjustments don't necessarily, while they may play out that way like in the marketplace, in the psychology it doesn't. Right. CFOs know, well, we're going to have this different cost structure, so prices are going to have to move them. We try to get on that as soon as possible.
Let me just do one question. I know Becky wants a question back in headquarters, but I have one other question to you. I learned Latin when I started covering the economy here, and there's this ceteris paribus idea, which is all things being equal. You guys had plugged in, on average, 2 cuts in the last SEP. Is that still a bias that you have? Do you think that if you could figure out the tariff regime, if you could figure out what was happening with employment, that you would still be cutting rates twice?
Well, it depends, right? So you know, I'm an economist, one hand on the other hand, right? But I would say this: it really depends on how things turn out. You know, at the beginning of this year, when we were thinking about tariffs, we were not thinking about them at the level that has been proposed here, or with the diversity across sectors and across countries, right? That requires a different kind of calculus, and for me, that's one of the reasons why I said, okay, we got to step back and pause, because the details are going to matter as to what it means in terms of flowing through to an aggregate picture. So for me right now, I'm expecting it's going to take a bit longer for that to sort out. I'm my SCP, I'm leaning much more into one cut this year, because I think it will take time, and then we'll sort of have to see. There are some scenarios where everybody grabs hands, they walk arm in arm, they're buddies again, and we wind up with a very different regime where tariffs are not an overarching story, and in that case, you might see the economy rebound much faster than it would otherwise. But really, we'll have to just wait and see.
Becky, thanks for waiting.
Oh, no, thank you, Steve. President Bostic, I just wanted to ask a question about the health of the Treasury market as you see it right now, because the FOMC sets rates, they set the policy, but ultimately it's the Treasury buyers that determine where interest rates will be. This morning we're looking at the 30-year up by about 12, maybe 13 basis points. The 10-year's higher as well. I guess the question is, do you think buyers are going to show up? And are there all of these questions around the downgrade coming from the United States and what Congress ultimately does in terms of budget they set, and whether they're going to tackle some of the deficits that have been building up for over a decade?
Well, it's something that we definitely are watching and keeping tabs on. Today, what we're seeing is that Treasury markets still are functioning quite well, and that's a good thing for us. I would say for me, I'm worried much more at this stage about just trying to figure out what's happening with our mandates, right? So we have inflation, which has been not moving toward 2% as fast as I'd like. We've had labor markets that have been solid, but we are definitely seeing signs of weakening. And those are the things that I spend most of my time focusing on. If Treasury markets start to get more complicated, then I'll have to really think hard, and I'll work with my team to figure out what that means for our policy and our mandate. But right now, I'm trying to stay really focused on the things that we're charged with doing.
I mean, I guess I ask because the last 100 basis points that the FOMC cut, you actually saw interest rates go higher. Didn't matter what you all were doing.
Well, look, as I was saying earlier, this is a very complicated time, and I think investors more broadly are seeing a lot of uncertainty moving forward, and uncertainty does mean that there's higher risk. And so we control only part of the cost of capital and debt. And so that's what we got. So there's a lot of other actors out there, policymakers and other countries that are going to make decisions that will ultimately decide that level. But we're really just trying to get our mandates and our targets back to where they need to be.